that, let's go ahead and get started, everyone. I am Shila Nieves Burney. I'm the founder and managing partner for Zane Venture Fund. We're an early stage venture fund investing in bold entrepreneurs who are building tech-enabled solutions primarily here in the Southeast and opportunistically across the U.S. I welcome you all to this conversation and really appreciate you joining. We have an awesome lineup of panelists today, and I'm going to go ahead and introduce them because they have the sort of information you're going to need when you're trying to get in touch with investors, how to even identify the investor you should be talking to, and then building those relationships in future raises. And our goal is really to help you understand how to break into the investor ecosystem. So let's kick off today with some introductions. First up is Mac McConnell. Everybody knows Mac the VC on Twitter. He is a software engineer by trade and was a former Department of Defense contractor with top secret clearance. He was a two-time founder with an exit and a failure. Next, Mac moved on to venture capital world via the Maryland Technology Development Corporation as part of their seed investment team. During his 4 years there, Mac amassed experience leading an initiative to create the first and only at the time state-backed pre-seed fund for women and minorities in the country, known as the Builder Fund. The program institutionalized the Friends and Family Round for Black women and minority-led startups, and subsequently was funded long-term by the state of Maryland. Mac then went on to found, which we all know, RareBreed Ventures, a pre-seed to seed fund that's investing in exceptional founders outside of large tech ecosystems. And so we really are happy to have Mac here. Mac, you want to say hey real quick?
What's going on, everybody? And don't worry, that sounds way more impressive than I actually am. Don't believe all the hype. We are here to have a good time.
And last but not least, we have Bernardo Brites or Brites. I want to make sure I get that right. He is the CEO and founder of Trade.
I never know how to pronounce it.
Okay, why don't you tell us how you want us to pronounce it, and then we'll do that. Is it Brites?
Sure, Brites. Whatever is easier for you guys.
Okay. He is the CEO and founder of Trade Finance, a global banking and FX provider for LatAm startups, a former head of partnerships for Decree, which was an $8 million which had a $8 million to 900 million market cap, and Transfer of Swiss, invested by FTX. Trade Finance raised a seed round led by Hope Capital and followed by Circle, the Chain Smokers Fund, Mantis VC, among others, and has already surpassed $300 million in volume this year. So welcome to you, Bernardo, as well. We are excited to have you here and hear your story. Okay, so we'll go ahead and get this kicked off really quickly because we have a great conversation and we only have limited time to get through these questions. Mac, let me start with you. I mean, right now we are certainly in a different environment that we both started out in early 2018, 2019. We were just getting into venture. Venture was still making large investments. And then we got into a heyday of 2020, 21. Where we saw large valuations and that sort of thing. So what is happening now in this environment? How has the VC system, how has it been affected with the current micro environment? And then what stages are most impacted?
Yeah, so we're seeing basically after the unprecedented time in venture, and typically this is how it happens. Like things grow, they get better, but we hit this ramp where things accelerated and there was an extreme amount of liquidity in the market. A lot of it had to do with we had been in a bull market for 13 plus years. We also had this proliferation of SPACs where a bunch of companies got basically exited and there was a ton of liquidity on top of, at the same time, Web3 becoming a thing. And there was a period of time in 2020, in 2021, I think there was a 120-day period where every day 800 new millionaires were created thanks to crypto. Right? That's a lot of new money.
That's a lot of money, yeah.
And so people were spending, people put money in everything, founders and companies were growing. And then also on post from a United States perspective, post George Floyd, we saw a lot of money going to underrepresented founders, underrepresented fund managers, all these mandates. It was a great time.
Right.
Well, when you look at this as venture capital is a subset of private equity. And so we are all tied to the public markets. And so when the stock market started to crash and tech stocks started to crash, well, the people who us VCs get our money from, they lost a ton of money. And when they lost a ton of money, they looked at us and was like, hey, y'all been spending a lot of money recently. We're going to pull that all back. Now, is it all going to come back eventually? Yeah, eventually, some point. But for now, things are going to be tighter. And so it allows VCs who have had 2 years of moving faster than they ever had to move before, where founders have more power than they ever had before. VCs are taking this time to take the power back. Now, this isn't necessarily new, right? We're seeing deals and we're seeing things happen like we saw back in like 2012, 2013, right? Where, you don't raise a seed round in 2 to 3 weeks. You raise it in 2 to 3 months. Like that's how it works.
Right.
Your seed valuation isn't going to be 40 million. It might be 15 million. And like, that's okay. But that's what we're seeing. And it's not different than what we've seen before in the past. But if you're a new founder, you've never experienced it, you're in for a rude awakening.
Right.
People are taking longer. They're not having the meetings is faster. Due diligence is going deeper, but it's okay. It's not a bad thing. Doesn't mean you can't raise money. And I should also say this. You hear a lot of people talking about how easy it was to raise money last year, how fast money was 100%. Happening. Raising money's never been easy. There's no such thing.
Right.
Raising money is always hard.
Right.
There's just less money of it. So it's harder now than it was before. But don't fall into this trap of thinking like fundraising is supposed to be easy. Or like fundraising, like most companies never raise capital. Like that's just the facts of it, right? And whether or not you raise capital isn't the end of the world. But we're in a tough place.
We are. And so just for the audience sake, could you explain who VCs get their money from? Because I think there's a big misunderstanding that we're dependent on investors just like they are to be able to fund companies.
Yeah. So the most entrepreneurial thing a VC can do is go raise a fund, right? We got to put a pitch deck together and we got to pitch high net worth individuals. So these are multimillionaires and billionaires. We got to go to family offices, which is just a group of family members putting their money together, or there was a successful member of the family in the past. And so this is the way they manage their money as a family. You go to foundations, pension funds, endowments are the money ran by schools. And so these are folks who have large amounts of capital that they're trying to diversify in investments. And we got to go to them and be like, hey, I got this fund. And if you give me money, I can make you more money, right? Like, don't forget, VCs are nothing more than glorified financial advisors. People give us money to make them more money. That's
you need to give returns for sure.
Yes, that is what we do. And so we got to go around pitching and asking for funding. And the thing is, we're only a portion of their portfolio strategy. Just like, a founder pitch us and we'd be like, hey, we're already invested in a company that's a competitor. We can't do that anymore. That's too competitive. We run into the same thing, right? And
as founders have to manage investor relationships, you guys also have to manage LP relationships. So if there's a downturn and if there's more scarcity on the market, or if people are scared, then your LPs will be bugging you. Oh, are you trying to deploy less? Are you doing more due diligence? And also asking you to, switch up your strategy just so that you can take better care of their money, right? So it's the same kind of relationship as like founder investor and then investor LPs in a sense.
100%.
Bernardo, so what kind of out of the box anecdotes have you had when connecting with investors as a founder? Would love to hear some of the stories. I mean, I know you've recently raised a seed round, but from a founder perspective, what are some of the things that you've done to try to connect with investors in this sort of environment?
100%. So, talking about last year, we have seen some crazy things happening, some term sheets given in less than 24 hours, and then getting multiple term sheets in, 12 to 24 hours. We have more than 100 customers now in LATAM, and most of them are startups. So we always intro them to investors and try to help them with the fundraising process. And definitely last year was a lot more heated than this year, but you still see a lot of great companies raising. So let's start with that. Last year, when we started the fundraising process, it's really funny actually, because in February, we announced our seed rounds, but you actually start to plan the fundraise, a couple months before you actually announce it, right? And I am a big fan of the Chainsmokers. So I actually learned that they had a fund called Mantis Ventures, right? Mantis Venture Capital. And, I really talked with my co-founders. They said, oh, let's give them a small location. Let's, ping them and let's see how it goes. It would be personally a great thing for me. And I think that for PR, it's also great. And then I talked with one of their portfolio managers. And at the time, we had a blast, had a great conversation, but it was really a cold call, right? So something that I really would recommend founders do before actually getting to an investor would either to get a warm introduction and actually get someone that you already know in your network, or if you need to hack into it and actually build that yourself, you can actually look at the portfolio companies that they have and then start targeting those guys so that they become your customers. And after they become your customers, then everyone around them will be talking greatly about you. So that's what we did in this case. So it took them a month to actually get back to us. And by then, we already had closed the rounds. And then they asked for, let's say 5x allocation. And then we said, oh, we can only give you 1x, right? Because we already closed the rounds. And but then we really thought that they could be helpful. And when we had a call with them, it was crazy because I really thought that we would meet Drew and Alex and have a 5-minute call. Where they would be, oh, hey, nice to meet you guys. Do you want an autograph and bye? And then get the conversation going for someone else, right? But then actually they spent 2 hours strategizing, saying who they invested on, all the portfolio companies that would be synergetic to us, and a lot of other very high-level things that we were quite surprised actually to know how deeply involved they are with their portfolio companies. So I would definitely recommend that founders either get a warm intro through friends, through other VCs, or through some of their customer base. But if you don't have that already, then why not build it in a way that is tailored to what you're thinking about your fundraising strategy, right?
Yeah, that's and I love the fact that you say if you don't find a way to hack into finding somewhat getting that relationship with the potential investor. And there are many different ways, and some of us do respond to cold outreach. So don't forget that as an opportunity too. So for both of you, what stages are impacted right now? We are seeing pre-Series A seed extensions and that sort of thing. So from your opinion, which stage of founders being impacted in this environment?
Well, I would say that mostly late stage is being heavily affected. So we are seeing flat rounds and even down rounds in some cases. And then a lot of companies that had this kind of mindset where growth at any cost and really trying to push their customer acquisition cost beyond the roof just so that they could get better numbers so they can raise another round. That kind of mindset actually changed a lot. So now our companies, moreover, on the growth stage, they are more thinking about how to become profitable as soon as possible, or at least to have some better economics rather than just trying to push their user base across 1 million users or some other metrics that they could push to. So I would think that early stage hasn't been that affected versus growth stage. But at the same time, you're not seeing the same behavior on the VC side where, you would get a term sheet in the same day and it would be quite euphoric, I would say. Right now, you still have the same 2019 type of fundraising process where it would take you like a month, 2 months, 3 months to actually get a couple term sheets and to go through the DD process.
Mm-hmm. So I would say all founders are being impacted, right? So yes, later stages being impacted more than others just because they're closer to their exit value, right? And so that's the big thing, right? For a VC, when we invest in a company, we're investing because we're looking for returns when you get to an exit. Where if you're already overvalued too early, that means the next VCs that come in later, the exit potential is so far lower, that's a lot harder for them to get their money out. And if the public markets aren't saying that things are good, well, that's what we're all shooting for. Unicorns come when you get an exit, you go public, right? Very few unicorns get acquired, right? It's usually going public that way. And so, so at the later stages, it's a lot tougher. Like if you got a $400 million valuation at your Series B, you might be going for a down round, right? That's not the norm. But earlier stage companies are getting affected because timelines are going slower, right? And we're starting to see a lot more structure in deals. So what that means is we're starting to see more terms in deals that we weren't seeing before, less standardized deals. So we're seeing more liquidation preferences. If you don't know what a liquidation preference is, go Google it or go to my Twitter. I did a long thread on them. Look them up. Getting ratchets and a full ratchet, like things like that. Those are things we typically see in later deals. We're starting to see in earlier deals, right? And like that's the kind of stuff we used to see in like deals of like if you talk to investors back in 2005, 2008 time, they were doing stuff like that early. That's not normally what you see at the earlier stages, but we're starting to see that. So, you know, you're getting lower valuations, slower timelines, and you need to watch out for these terms and structures that are getting in the deals earlier and earlier. So it's happening across the board. Everybody's being affected just in different ways.
So with this environment, what do you suggest? What kind of tips you have for folks, for founders to find investors who are currently investing?
So it's all about network, especially as an early stage founder. Like, and I'm speaking specifically to early stage founders, right? Your first round or 2 rounds of funding are very, very dependent on your network. And if you don't have that network, then you got to go about building it. So the question is, how do you build that network? Well, you can reach out to investors cold. You can DM them on Twitter. You can reach out to them to LinkedIn. You can send them cold emails. You'll get varying results. Many investors don't take cold outreach. Some do. But I'll tell you, the ones that do take cold outreach get a lot of it. I take cold outreach. I get 20 to 40 companies come at me a day. Right. Like I'm not going to look at all. I'm not going to look at all 20 to 40 of those companies every day.
Right.
I'm not going to look at all 200 to 400 companies that come across my desk every week. Like I'm going to look at some subset. So like there's that. Really what you're trying to do is you want to find somebody who knows somebody that works at a fund. Right. And that's like how you're supposed to do that. Do what you're doing now. Then you're going to network. You're going to go to events. Right. You're going to put your LinkedIn stuff in the chat. You're going to meet with people. And as you meet with people, you're going to find people who want to be your mentor, who want to be an advisor, who want to help. You're going to meet other entrepreneurs who you're going to become friendly with. Right. You're going to meet somebody like Bernardo who's going to be like, hey, you know, you're really cool. We've met 2 or 3 times. You know, I see you working hard. It's not you have one cold call with Bernardo and be like, hey, Bernardo, I know you know Mac. Can you make an introduction? Like, no, you want to authentically try to build a relationship so that Bernardo feels like he can trust you. He believes that you're building something and be like, hey, you know what? I know this guy, Mac. He might be good for you to talk to. Like, that's how you do it if you don't have the network. And that takes time. There's no hack to like, hey, I need to raise capital. I'm going to raise over the next 3 weeks. I'm going to start now. Nah, it's going to take longer than that. Even for Bernardo, when he wants to raise his next round, it's not going to be like, you know, I'm going to start on this day and I'm finished on that day. Like, no, he's going to gear up for it weeks, if not months in advance to get ready, to get people primed, to meet with folks. You know, you want to go to, if you're okay in this COVID world, go to those in-person conferences, give out your cards, follow up with people, right? Like, that's the process of building your network, and it takes time.
It takes time. And so go ahead. I'm sorry, I cut you off.
Yeah, I would definitely say that one little hack that you could use to actually build that network would be to get some of those founders that you mentioned that you could become friends with in your cap table. So if you can actually do like a founders round or something similar to that, where you can get strategic people into your ship in a sense, then you have a much better into, you know, a lot of those venture capitalists that you're thinking about building relationships with. So we got over 30 founders on our cap table for the seed round, and they have been super helpful. But of course, you need to build relationships with other VC funds that are later stage, or even get partners of those late stage funds into your earlier stage rounds, because they are very well connected and you get all of the perks that they could bring without actually getting the downside of the extra dilution that they usually bring with.
Yeah. So which points?
Real quick.
Go ahead, Matt. Go ahead.
There is one semi cheat code to building this network. And it's for a founder joining an accelerator. And so it's somebody who runs an accelerator program. Shila, why don't you share a little bit for folks, like what the value is of that and how that builds relationships with investors?
Sure. So we have a program, it's a capital readiness program where we are actually preparing underrepresented founders for their first capital raise. And so for us, it's the value added network, right? And so we bring in folks like Mac and other speakers who you have a time to talk to about a particular subject on raising capital and getting their experience on how to do that. And so we've done 3 cohorts so far. These companies have gone out and raised over $10 million. We're waiting for the next cohort's numbers right now. But the fact that they have now met, other founders who can help them with their companies, could give them suggestions on different resources. And so the accelerator, and there's so many of them out there. We're one of many. We sit here in Atlanta, but there's so many across the country that you can get into, and you can find lifelong connections to help you as you begin to scale your company. And so accelerators are a good way to Mac's point, to hack the network piece. You get in, you get to meet investors, you get to meet all of these other folks that are in the ecosystem, and it just makes for a better, as you start to build your company, it just makes for a better way to network and meet folks who could potentially be investors in your company. And so, but what I wanted to, and this is for you, Bernardo, especially since you look at this from a different lens, how do you know? One of the things that we both, Mac and I both probably deal with is that founders come to us. They don't know what kind of companies we invest in. They've not read our website. They just say, oh, it's an investor, I'm going to pitch my company. How does a founder know if an investor is a good fit? And are there any red flags that they should be looking for?
Well, I think that definitely you should do your due diligence on the investors before approaching them, not only on the, some of the practices that they have and get some feedback from other founders that have been invested on them. But also, you have simple things that you should do on your homework to actually approach those investors. So if you're a fintech and you're approaching a health tech investor, then they will be like, what the fuck? So basically, you should really tailor the list before actually approaching investors. So I would say that there are investors that are focused on a couple of verticals. There are some that are more generalists. Mm-hmm. And then you have like the big funds like Andreessen, Sequoia, and like Index that are that have a couple more verticals that they invest on. Mm-hmm. So I think that you should definitely look at some of the other companies that they have invested on and really look at the benchmark. So for example, in our case, we are building a company in Latin America where we want to basically create a global financial ecosystem for all the Latin American founders and companies that are being built in the region. So we really look at benchmarks such as, Mercury, such as other fintechs that were invested by those VCs to look, okay, that's a great fit. So you should really think about other companies that are doing somewhat the same thing that you're doing in another region. And then that investor might invest into you. Moreover, if you are US based or Europe based, then it's a no-brainer. But then if you are Latin based or like Africa based or some other emerging region, then you should really see if that specific funds is already investing into those regions, right?
Yep. And what kind of red flags should we look for? And this could be for both of you when looking for an investor that's a good fit.
Well, I think that's when you bring a partner on board, you're really bringing, someone that will be your friends for the next few years at least, right? So it should really be someone that you sympathize with and that you can have like a healthy and friendly relationship with. So if you're bringing a partner on board that you can really see on his face, and then you're thinking, oh my gosh, I can't stand this person, then come on, you have that person for the next 5 to 10 years. So you should really think about that investee alignment. But also I think that you should really talk with some of those other founders. And back to Mac's point, I think that's having that founder network around you is very important. So you can actually get the feedback, get the experience from other founders that have raised from those funds before. And whenever you do approach them or get approached by those investors, you can actually hit that person and then ask, oh, hey, I know that you were invested by SoftBank. What do you think about them? And, is there something that I should be worried about, or should I look into something before actually approaching or being approached by them? So I think that it's really doing your homework on not only things that are bad or red flags essentially, but also on their investor profile, like the way that they invest on and what they are looking for. Because there are investors that are a lot more analytical, they want numbers, and they want really to look deeply into your projections and so on. And then there are investors that are much more about, talking with your customers and knowing how your hiring process is. And there are different investors for on taste, I would say. So really trying to get your best fit there.
Okay. Mac, I'm going to go to a few questions in the chat, and I wanted to ask this one of you. If you like an idea or a product, but it is unlikely to make significant money for some years, would you still invest?
It's not about whether or not it'll make significant money for some years. It's a matter of it has the exit potential to potentially be worth $1 billion, right? Mm-hmm. So we are like venture capital is based off what's known as the power law. And all that means is our funds are only as good as the best investment we make, right? It's not about having a bunch of okay investments. It's like for you to have a good fund, you got to have at least one company that does really, really well, right? So every company we invest in has to have the potential to be that one company. Now, the other issue is if it takes your company longer to get to the point of getting to significant revenue, the question becomes, if I give you money today, and let's say it's at your pre-seed or seed round, are you going to grow enough for more investors to want to invest in the next round? If you tell me it's going to take you 3 or 4 years to get to the point where you're ready for your next bit of money, where you'll have the metrics to raise more capital, but you're going to tell me, hey, Matt, it's going to take another 4 or 5 years to get there, but you're going to give me now. We're not going to have those metrics, but I'm going to need you to give me more money so I can get there. Mm-hmm. I'm not going to be able to do that. Right. So if it's something that takes a slower time for you to get to your big growth rate, then you need to make sure you have investors that are willing to take that long-term view. Right. Or you may have a company that's just not suited for venture capital, and that's perfectly okay. Not every company needs to raise money from you.
Bernardo, question for you, and then we're going to go back to our regular questions. So from the chat, how do you keep your cap table clean if you have 30 founders? That's a really interesting question, and I would love to hear your response to that. And Mac, you can weigh in too after Bernardo, because that's interesting.
Well, to be honest, it's not that much of a headache as people usually put it. So, having 30 founders on the cap table, and late stage investors as well, late stage partners that wouldn't invest with their funds at this stage, is very helpful because you can actually get all the connections that you get from most of those guys without actually getting the dilution or other downside that you would get getting a bigger investor into that round. So the only downside I would say is that you have to collect a lot of signatures if you want to do something very big. But moreover, if you're doing a safe round, then it's a no-brainer. And if you want to do, change anything before actually going to your Series A later, then you just need to have 50% plus one, right, of the vote, so of the shares. So it's really a no-brainer because most of the rounds is usually done by a lead and then a follower or 2-3 followers. So even if you have 30, 40, 50 founders on your cap table, it wouldn't really be much of a headache or any bureaucracy whatsoever. In our case, for example, waiting on what Max said about returning the funds, Hoff actually said to us, okay, we invested in you because we think that you have a 10 to 20% chance of actually becoming a decacorn. And that's why we thought that you would be a great investment, and we really love your crypto backgrounds and all of the above. But really, to Mac's point, I think that if you can't return on that funds at least one time over, then it's very unlikely that an investor will end up investing in you.
Mm-hmm. Okay, Matt, what do you think about the 30 founders on the cap table?
On 30 investors.
Oh no, yeah. 30 founders.
Well, yeah, you can have founders as your investors. I would say,
yeah. I'm assuming that's go back.
It's all about relationship management, right? And keep in mind, your investors only have but so much they can say to you as you run your company. The bigger issue isn't really so much the number of investors you have, but it's about the makeup of your board. Your board is far more important, because like
100%.
The board's job is to deal with executive hiring, executive compensation, including CEO compensation. Like once you get a board, you no longer give yourself your own salary. You got to get that approved by your board. And then hiring and firing CEOs. Like those are like the three things that a board can actually do.
Right.
And so you want to make sure the folks that are on your board are folks that you want to work with and build with long term. Right. So be careful with that. But having 30 founders on your cap table as investors in your company, they are sometimes the best investors for you to have. Absolutely. Because they will make introductions, they will be engaged. Like for them, they only have
the empathy as well.
Yes. And they only have a few investments, right? Like I have 38 companies in my portfolio already, and it's only going to grow larger. Mm-hmm. Those 30 entrepreneurs who invest in you, there's several of them where you're the first or only investment they've ever made or ever will make. So their attention to you is going to be there. If you ask for them, they may return that email or text message faster. But like those sometimes are some of the best investors for you.
I like that. 100%. I love that you mentioned the board was really the most critical piece for a founder. Understand the cap table and making sure it's clean and that sort of thing. But when a founder is now having to pick a board, how that being a very critical process for them. And, in today's environment, we want to, really educate founders on how to do that. We've added that as part of our programming, because we now know it's critical that they know who and how this board works for them in their company. Okay, let's pivot back to building an investor network. Matt, what's the best way to connect with investors that don't have a warm connection to? We talked earlier about the cold outreaches. And Bernardo gave some hacking on this, but we're talking about and actually building an investor network. Like, what are some of the things that founders should think of when doing this?
If there are specific investors you want to get in front of, if you see that they're speaking at an event, go to that event. If you meet them in person, you got a better chance of getting in touch with them. Here's a sneaky tip. Most investors have their portfolios on their website. Go through the companies in their portfolio and start reaching out to some of the founders, because founders are always happy to speak to other founders.
Absolutely. Yep.
Build a relationship with some of those founders. If you build that relationship, they'll make that introduction for you, right? Like that's a sneaky way to go about it. And the cool part about that is there's no founder that only has one investor. So if they like you and they think it's worth it, if they got 30 founders on their cap table, they may introduce you to 10 of them, right? You never know. So, if old school way, meet people who know these folks, go to the events where they're going to be at, and then look at the companies they've invested in and network with the founders who have been there. It's the same playbook for getting in the Y Combinator. Everybody says, if you want to get in the Y Combinator, you meet with founders who have gone through Y Combinator, and then they submit you. It's the same game to get to a VC.
Mm-hmm. I love that. Bernardo, you were going to add something?
Yeah, I definitely double down on what Mac's saying. I think that, looking into the portfolio companies from those investors, and then actually reaching out to them, getting them as customers, creating relationships with them, and then actually, having dinner, lunch, and getting to know them. Because if you build out that founder network, then you can get help not only on VC and fundraising, but also on product development and actually tailoring your growth strategy so that you can reduce your customer acquisition costs and all of the above. So I think that's really going into, moreover, if they're on the same vertical as you, tapping into that founder network is really great for you.
All right. Would you ever circle back to a VC that said no? And if so, how long would that time frame be before circling back?
That's a very tricky question. So I would, the default answer would be, wait for the next round, but still build that relationship and try to make it so that you become friends with them on a personal level rather than only on a VC level, and be helpful to them, introduce great companies to them, try to provide some value as well, and make that relationship stronger. But at the same time, we have tried on a seed round to get some followers on board that we thought were strategic, but like small checks. But after you get a no from someone, even if they end up convinced that it's a yes, it's too much trouble. Moreover, if it's a bigger firm to actually go back on their word, right? So after you get a no from let's say a principal or partner from one of those firms, it's very tricky to convince them otherwise. Besides, the next round, because next round is really where it gets you start over essentially, right? You have other numbers. You might be a totally different company because you pivoted. So, unless you made them hate you, I think that it's definitely worthwhile to tap into them after you're planning on raising a next round. But it's definitely tricky, right?
So Matt, how do you thanks Bernardo, but how do founders stay in contact with you after the no? They're now raising their next round. Like how would they maintain that relationship in between those rounds? What are some of the things that you've seen as founders, came to you and they still wanted to be in contact with you?
If I give them permission, add me to your investor update list. I get the regular updates. As your company's growing, do personal one-off emails or outreach, just like, hey, how you doing? Just want to give you an update. If you have some time over the next, 2 to 4 weeks, we'd love to get on another call just to tell you about what's going on. We're not raising capital right now, but we'd love to get your thoughts. And this is a great one. Like the old adage is, if you want for money, if you want advice, ask for money. If you want money, ask for advice. Right. So sending me an email and saying, hey, here's how we're doing. We're thinking through some go-to-market strategies. We know go-to-market's a big thing for you, Mac. Could we get 15 or 20 minutes of your time and maybe talk through some of the things that we're thinking about? Mm-hmm. That's a great way to stay in touch. It's a great way for me to see if you're coachable or how we can work together. And it's a great way for me to see how you're growing over time and being invested, so that when you get to your next round, it's a lot easier of a conversation, mm-hmm. right? So having multiple touch points along the way before your next round, and not just defaulting to, well, you passed on me before, I never want to talk to you again. Well, money's still money, and you never know how much I can help. And the reason why I passed could be for a myriad of things. It might not even be because I don't believe in the company, mm-hmm. right? So you never know what's going on.
In between funds and other reasons that are more macro rather than not liking the company specifically. And moreover, to your point about asking for advice, I think that's a great hack. VCs are going to hate me for saying that, but a great hack to actually try to build relationships with VCs and do the first outreach, even if you're not raising. Moreover, if you're not raising, actually, is to go to one of those VCs and then ask about a portfolio company that they have that would be your service provider. And I thought, hey, can you intro us to someone at that company? So let's say in our case, we had an AML solution that we wanted to hire, and we were thinking about a couple. Then we reached out to a VC. Oh, hey, can you intro us to someone to a C-level there so we can get things going? And then they introduced us to them, and then asked for a call as well to learn more about the company. So that's definitely a great way to start a relationship going as well, if you have to go the cold call way.
Okay. Our last question, and then we're going to go to the chat. So in terms of timelines and folks are getting ready to raise their next round, how early should they start contacting you, Mac? And what are you looking for when they come back to you in terms of runway, that sort of stuff?
This one's a little bit tricky, right? You want to start the relationship early enough so you can build a rapport, but you don't want to start too early. And what I mean by that is, if you come to me too early, we're going to have a meeting. You're going to tell me about all the amazing things you're doing and all the amazing plans you have and all the amazing people you're having conversations with, right? And I'm going to be like, cool, it's a great touch point. Maybe you're a bit early for where we are, but I like what you're doing. Let's stay in touch. Well, you just told me all the things that you're doing. So now you've started the clock. So that means when I talk to you again in a few weeks or a few months, I'm going to ask you, so how are those conversations going? You said you were working on a deal with Chevy. What happened with that? Did that deal happen? You said you were working on a partnership with Twitter. Did that come through? Well, if it did, great. We got great things to talk about. If you're still in talks or if they haven't gone anywhere, that is now a new touch point for me to be like, okay,
100%.
They're not moving as fast as I thought they were. So you want to start talking to investors when you've got a little bit of momentum moving. That way, when you get to the peak of your momentum, you can start raising your round that we've already built that rapport. So it's a little bit of a dance.
And sometimes you got like a partnership with Reddit, but then you were mentioning Twitter, and then they will be focused on the Twitter deal, not the Reddit one. So getting that like early projections into the investor's mind, and then not coming up with exactly what you said you would promise, then you're in a tough spot, right? To get that unwrapped from their mind, I would say.
So we're going to go ahead to some questions that from the audience. Thank you all so much. That was a great conversation between the two of you regarding building the investor network. So Mac, how would you evaluate a single founder company versus one with 2 or 3 founders?
So you said a solo versus a company with just a team?
Right.
Look, some investors flat out do not invest in solo founders, right? It's not every investor, but there's some investors who just flat out don't. I'll invest in a solo founder, but here's the thing. The reason why folks don't like to invest in solo founders is it's impossible for you as a solo founder to do everything. Mm-hmm. Like, you're not going to build the products. You're not going to do Q&A. You're not going to do design. You're not also going to be doing fundraising, marketing, brand building. It's too much for one person. Right. But if you've already spent time building that out, doing it, I built my product first, took care of that. Then I started building the brand, took care of that. Then I hired some people, took care of that. And now I'm moving and I got traction. Well, I can see the hustle. I can see the grind. I can see you know how to put a team together. You know how to grow a company. I could probably invest in that, right? As opposed to if you have a team where it's like, hey, we're 3 co-founders and our 2 co-founders. I know as a co-founder, everybody's all in. And everybody's probably not getting paid because they believe in this vision of being all in. And so, like, having a CEO who's focused on all the venture stuff and social media and marketing and being sales, having a CTO who's all in on building the product, where if anything, like if I as the VC who's looking at your stuff, like, hey, I see this interesting thing on your website. It looks like there's a mistake there. And like 2 hours later, it's fixed. That's the power of having a CTO who you're not paying, who's there to make changes, and having somebody who's there to design on like that kind of team. There's going to be bias towards that because of the ability to move faster, because you just have more hands going. But if you have the ability to hire your team and you can show that you can execute, solo founder is not the end of the world. Right. Just know that a solo founder is never going to get the same initial look as a team.
Absolutely. Absolutely. Thanks, Mike. Bernardo, for you, what do you think is the best approach? Going to a tier 1 VC to create FOMO from the top down, or getting a deal from a tier 2, assumingly at a higher valuation, and then using that to create FOMO and have a tier 1 match the better offer?
Well, it really depends on who you're talking with, because some investors get spooked by that strategy a lot. Just trying to build a ladder with other investors, and then I'll get the term sheet from a tier 1. So I would say that best strategy, in my opinion, would be to try to serve some of their portfolio companies if you are a B2B company, and then have them really love your products and be crazy about you. And then whenever they talk with some of those customers that you have, they would be delighted, and it would be if they ever say no, it won't be because the customers don't love you. It's because of any other reasons. But besides that, I would say that if you are coming from like a seeds round and then you're trying to raise your Series A, try to tap into your investors in your cap table. That might help you get those intros. So of course, Matt could even add to that, but of course, it's a little biased for one of your current investors to try to sell you to another investor. But surprisingly, that usually works, right? So I have been to dinners with a couple of investors that are friends, and they are like selling one deal to the other, and then they're like, "Oh no, let's do it. Let's do it together." Or if you do it, I would do it. And I think that's trying to get another investor to enter you is also very powerful. Moreover, if you have already gotten them into your cap table, so when you have, let's say, a deal that would be co-led by another fund that has already co-led deals with them. So one strategy that I see a lot of founders are doing here in Latin America is to get a local fund like Monashis, and then say, oh, hey, I already have Monashis on board, and now I'm trying to get CRV on board, or trying to get Investment on board, or some of the other folks like Lightspeed and so on. So trying to do this two-way deal in a sense.
Okay, thanks for that, Bernardo. So, and this, I know this differs, Mac, but what's a typical VC stake at the seed stage?
At the seed stage, you're looking to give up typically somewhere between 10 to 25%. 20 to 25 is fairly standard, right? The more leverage you have, the more equity you can keep. But typically, from seed, Series A, leading into Series B, you're typically around the 15 to 25% range. Now, understand, that's not you giving up 25% of your company each round, right? It's dilution works that, like, if you give up 20% today, you own 80 and the investors own 20. Well, when you give up 20% and then let's say 25% the next round, everybody loses 25%. So you lose 25% of your 80 and those VCs lose 25% of their 20, right? So every time you raise money, you create a new 100% that everybody shares in selling equity. So when you raise money in the future, that means you're also giving away your VC's money as well, unless they give you more money, right? The only way the VC gets to keep their stake is they have to keep giving you more money so that their number doesn't go down too.
Right. And so saying that, what are some good resources for how to navigate to get one or more investors interested in the first round? And that could be, Mac, if you'll answer that, and I would love to hear Bernardo's response as well.
Well, if you have done your homework and done the time and you've built the network, the best way to raise is you want to run a very tight process. And what that means is you want to set up as many meetings as you can in a 2 to 3 week period. Because what it does is every time when you go to finish a meeting, you can always say, hey, thank you for your time. Would love to know what your interest level is, because I have another 30 meetings over the next 2 weeks. And if you're legitimately interested, I'd love to know so I can hold some allocation for you as I go, right? That's the way you try to create FOMO. Now, understand, just because you say that doesn't mean anybody's going to jump, right? But at least having that gives you some leverage. And it lets you also get a lot of meetings in a short amount of time, which allow you to start to figure out very quickly what's working in my pitch, what's not working in my pitch, what are the questions I'm getting the most what do I need to double back on? That's the way you want to run a tight process.
Okay. Anything to add to that, Bernardo?
Yeah. In our case, we first started raising for $2 million. And then when we got the term sheets, it was a term sheet for $1 million. So we really figured, okay, we don't want just one investor on the cap table. So we figured that we would raise a little bit more and then add more people to the cap table, just because we wanted that network built, and some of the founders on the cap table as well, some late stage partners, and a couple other followers that would be strategic like Circle and Stellar and so on. And then basically it turned out that when we got the term sheet for two, then it turns into three. And after three, we said, oh no, we're done. We don't need more. But then we got a lot of interest from a couple of other funds that we said, okay, let's just add them to the table and keep the cap at 4 on the but then Mantis came along from the chain smokers and we gave them a little more inflation. So if you start with a smaller number and then you fill that up quickly, I would say that then it's a lot easier to build funnel because you're not really looking into okay, I want to raise $5 million and I have 500K in. You're looking at, okay, I already raised whatever I was planning for this batch in a sense. And then whatever I raise is extra. So when I'm like oversubscribing my rounds in a sense. So even on when we ended up raising $4.3 million, we were oversubscribed a couple of times. So if you can get the first term sheets or the first interest, then it's a lot easier to raise the rest of the capital. So let's say that your capital needs would be $3-4 million. Start pitching investors that you need $1.5 million or $2 million, and then it's a lot easier to get a term sheet around that number than to get a higher number, and then you can just build around from that.
Mm-hmm. Thanks for that, Bernardo. Matt, what are the pros and cons of continuous fundraising versus imposing a clear deadline and saying our raise closes, say, on September 7th? What do you think is the best approach, especially in this current market?
It depends. Again, it goes back to your network and momentum that you have, right? If you feel like you have the momentum or you have the interest, you got a lead investor, you got a bunch of investors and who are interested but haven't pulled the trigger, well, then, yeah, you set a clear date. This is when we're closing. Either you're in or you're out. And you may not get all the money you were looking for, but hopefully you've already soft circled enough money where you can do what you need to do. If you're just trying to create the FOMO and you don't have that lead investor, or you haven't had anybody show interest in wanting to be a lead investor, or you don't have, 5 or 6 funds that have shown like real interest where you've had multiple meetings, then you probably don't want to have a clear date. What you will want to do is you'll want to raise on safe notes or convertible notes. I suggest safe notes. And what you'll do is as you raise over time, you'll want to raise the valuation cap on those notes. So let's say you got $200K from an investor, you're at a $6 million valuation, and then 3 months later, you got another $100K, you're still at the $6 million, and 3 months after that, somebody's like, hey, I want to put in 500. Well, it's been 6 months since I started raising money. We've done these things with the money we've raised. Our company's actually a different company today. So instead of the $6 million cap, we're now at an 8 or we're at a 9, right? So like every so often you need to be bumping that valuation cap up. You don't want to be in a situation where you're raising for an extended period of time and using the same note terms over like a year and a half, because you're going to look up and think that you gave away more equity than you were planning to.
Mm-hmm, mm-hmm. Anything you want to add, Bernardo, before we end?
Yeah, I definitely agree with that. And I wanted to mention that Mercury has a seed program and a Series A program as well. We have done both, and it has been super helpful. So on the seed program, you get intros to a ton of investors, and it's super fun. And then on the Series A program, you spend the day with a couple investors, and you have like some panels, and you have some of their perspectives, as we are getting now with you guys, on the VC side of the table, on how we can get ready for the Series A, or how we can get on track to start the fundraising process. So really, I wanted to shout out to that.
Thank you. And that's a good segue to our closing. I want to thank everyone for attending today's event. I thank Mac and Bernardo for their great insight on how to build your investor network. For more information on Mercury, connect with them at mercury.com. If you want to know more about their RAISE program, connect with them at mercury.com/raise. So thanks, everyone, and have a wonderful afternoon.
Thank you, everybody. And thank you for the great job moderating, Shila. It's always great to be here with you.
Same here, baby brother. So good to see you.
Likewise.
You too.
Great to see you as well, Bernardo. Have a good one.
Good to see you guys.
Bye, everybody.
Have a good day.